Okay, now let's pick up where we left last time. So if you remember, last time we started talking about, we were talking about issuing stocks, right? We talked about issuing par value common stock, no par value common stock. I'm just going to show you that just as a reminder. If you remember, we have for par value, for par value, you have cash will be debited when the company issues stocks for cash. We say for cash because sometimes companies might issue stocks for things other than cash, which is, for example, like to pay for a service. Instead of paying in cash, they don't want to part with cash, they can issue stocks. So, issuing stocks for cash, the company will debit cash, the amount of basically based on the market price. This is how much they actually sold those stocks. They will credit common stock par value. If it has par value, it will be credited. Common stock will be credited par value. If it does not have par value, the company will credit what? So basically, if it has par value, the company will credit common stock par value. Okay? If it had stated value, the company will credit common stock stated value. Anything in excess of that amount will be credited to paid-in capital in excess of par value. If it has a par value. If it were stated value, it would be the same thing. Replace the word par value with stated value. Okay? So that was the first example. Second one here, where we had no par value, but it did have a stated value. It has a $5 stated value. So it had a $5 stated value. What did we do? We debit cash according to the market value. This is because this is the amount of cash the company will receive for selling those stocks. We credit common stock stated value. Anything in excess is credited to paid-in capital in excess of par value or in excess of stated value, depending on whether you have par value or stated value. If it has neither, if the common stock has neither par value nor stated value, we credit everything to common stock. This is it. It will be like this one here. We simply credit the whole amount to common stock. So this is what we covered last time. Any questions about this? Okay. In certain cases, the company might issue stocks for non-cash assets. So for example, the company wants to pay their attorneys. They have the company incorporate. The company is starting. They don't have a lot of cash. Instead of paying them in cash, one thing they can do is they can pay them in stock. When they pay them in stock, we have to decide, because we have to decide on whether stocks, the issued stocks, can be the value of the issued stocks is easier to determine with accuracy, or whether it is the value of the service provided or the good that is purchased. So for example, again, if the company purchases a land and they issue stocks in return for that land, those are different scenarios where the company will basically have to see which one is easier to determine, which value is easier to determine. And we'll see in a second how. So one of the problems is that the service provided or the land, for example, could be advertised for $100,000. It doesn't mean that this is the actual 100% value of that land, right? In many cases, it's negotiable. So if the company agrees, basically they have an agreement with the owner of the land to buy the land for 70,000 shares. This is the point. Are you going to use the 70,000 shares as determinant of the cost of land, or are you going to use the advertised cost of the land? So let's see this example and you will start understanding better what we mean. Attorneys have helped Georgian company incorporate. So this is when the company started. They have billed the company $5,000 for their services. Remember, service is, in a way, in many cases, they can be negotiable, right? And $5,000 is the bill. They agree to accept 4,000 shares of $1 par value common stock in payment of their bill. So now we have to announce. This is a problem. You have to announce. The bill is for $5,000. If you want to look at the stocks, it's $4,000. Which one should be recognized as expense? The 5,000 or the 4,000? In this specific example, at the time of exchange, there is no established market price for the stock. So the stock is not being traded yet. Which one can you say is more accurate? In this case, it would be the 5,000. Why? Because those are 4,000 shares of $1 par value. We learned already that the market price of the stock does not always coincide, or is not always the same as the par value. So the 4,000, it depends on when the company actually issues the stocks. The value might be different because it's more of a speculation at that time of how much the stock will be valued at. This is why it seems that, for example, the attorneys are willing to take 4,000 shares in return for $5,000. Okay? So in this case, the company will use the $5,000, right? Because it is easier to determine. So organizational expense will be debited $5,000. The company issued stock, so common stock will be credited $4,000. Remember, it's common stock will always be done at par value or at stated value. As long as there is a par value, you will record common stock at par value. So this is again at par value. And the difference between the two is paid in capital in excess of par value. Okay? Now, I'll give you another example, and then I think it will become a little bit clearer. Athletic Research Inc. is an existing publicly held corporation. It's $5 par value stock. It's actively traded at $8 per stock. So it's $8 per share. That's the price of the stock. We know it's in the market. The company issues 10,000 shares of stock to acquire land recently advertised for sale at $90,000. Which one do you use in this case? Which one is easier to determine? Lauren.
Well, I guess the expense is still like $90,000.
That's not an expense, that's the cost of land. They are buying a land.
Yeah.
So the cost of land is?
$9,000. Well, okay, so the cost of the company is technically the 10,000 times 5 because that's what it's like.
No. What's worth the company is 80,000. It's 8. This is the value of their stock. Remember, this is the thing. The value of the stock is actively traded. This is the trick. This is the key word. It's actively traded. That means on that day, the company went online and they saw that their stock is traded at $8 per share. Whereas the 90,000, that's an estimation of the value of land. Remember, there is always, it's like when you try to buy a house or land or anything like that, there must be an appraisal, right? It's advertised at $90,000. Basically, the appraisal was more or less $90,000. The appraisal is not the exact value. This is the estimation of the value of land. If we did not have a better determinant of the cost of land, then you would use 90,000. In this case, you know for sure that the company had their stock traded on the, basically their stock was traded on the market. In other words, they know that the value of those 10,000 shares is 80,000. That would be the cost of that. Can they determine easily? Which one is easier to determine? One of them, they just look up the price of the stock and they accepted 10,000 shares. So it's 10,000 shares multiplied by $8. How much is the cost of land? 80,000. On the other hand, the other one would require them to send someone to estimate the land, for appraisal, etc., etc., etc. They could negotiate the price and stuff like that. With the stock, it's basically the same thing. So this is why, in this case, the company will debit what? Land, right? They are buying land. So that land will be debited $80,000. That's cost. This is. So in this case, this is cost. Okay? According to, so that's cost according to the market price. Common stock is going to be credited at par value. So common stock will be credited at par value. The difference between the two will be credited to paid-in capital in excess of par value. So in this case, the company will debit land. So basically, for those examples, we're not going to basically make any complicated examples. Think about them. Which one is easier to determine? If the stock is actually actively traded, then it's easier to determine the value. So in your problems, in the homework, in the exams, when you see that the common stock is actively traded, use that value. If you see that it's not actively traded, then use the other determinant if it's easier basically to determine. Lauren, you had a question? Okay, so let's do this one. So on May 10th, Romano Corporation issues 2,930 shares of $14 par value common stock for cash at $17 per share. Is this journal entry correct or no? That's good. Okay. This is why I said that was good. So, the company issues 2,930 shares of $14 par value. So the par value is $14. Okay? It is sold for cash at $17. So this is actually what in this case, what we did, we credited the whole amount to common stock. That's not correct. You need to credit common stock only par value. The remaining is paid-in capital in excess of, that's the correct answer. You debit cash based on the market value, okay? And you credit common stock based on par value. The difference between the two will be a credit to paid-in capital. Any questions? Okay, so we do have majority who got it right. So in this case, what we have, again, write the journal entry. How do you write the journal entry for this one? We have company sold those stocks. They issued those stocks for 140,000. That's the amount that's the amount of cash that the company received. Par value is $5. So the company will actually debit cash 140,000. They will credit common stock 20,000. That's based on par value. This is based on the market. The difference between the two is paid-in capital in excess. of par value, that will be 120,000. In this case, you look at the different answers you have. What do we have here? The only one that actually fits this one is B. I personally find it difficult if I just try to answer it directly without writing the journal entry, in that it can get confusing sometimes. I personally find it much easier, and in a way, I have more confidence when I give my answer, when I write the whole journal entry, and then I look at the four answers and see which one is the correct one. When you have a question like that, you have two parts. They are asking you to write a journal entry. But think about it as a two-step problem. The first one is you need to decide which value to use. Are you going to use the service, the bill that they sent, or are you going to use stock, the issuance of stock? Once you have that one, then you can move on and decide on the amounts that will be debited or credited. Okay, you guys were very close. Remember, here again, it is approximately, the amount here is, they say that it is approximately 10,000 by issuing $5,000 of the stock that is traded on a daily basis, which is to mean which one? When it's traded, it means that it's more accurate, it's readily available, easier to determine, so we take the cost of the stock. Okay? So we take that the company is issuing those for legal expense or organizational expense. So in this case, let's say that legal expense will be debited the amount based on the market value of the stock. So this is 5,000 multiplied by 1.8. It's according to the market price. On the other hand, common stock will always be based on par. The difference between the two is credited to paid-in capital. Okay? So those of you who got it wrong with regards, like they use 10,000 instead of 5,000, at least you got the idea of basically how to write a journal entry when it comes to paid-in capital, which is the harder part. Always think about it this way: if you have a stock that is traded actively, that's usually easier to determine than a bill or an approximation of an invoice or something like that. We get to treasury stocks. So treasury stocks are stocks that the company has issued and bought back. Remember, when the company is granted a charter by the state, what happens? The state will decide on the number of issue of stocks that are authorized to issue. Say that this is 1 million shares, okay? So the charter decides that it is 1 million shares that are authorized. The company might issue 500,000 of them. So those are issued stocks. Outstanding stocks might be 450,000. 450,000 in outstanding, it simply means that those are the amounts, this is the number of stocks that are issued and they are still owned by shareholders, which automatically means that the company bought back 50,000 shares that were issued. However, for a certain reason, the company still does not want to retire them. They want to keep them. Why would they keep them? Can you give me an example? Why would the company want to keep those treasury stocks and not simply retire them? Yes?
So that they can sell them later and not have to issue more?
So they can sell them without issuing a new stock.
Yeah.
Okay? This is basically when they sell them or they issue them again, and this is correct in a way. So, yes, Laura.
What kind of retains ownership too, or we still have that ownership for their stocks?
It could be that the company wants to, for example, have less aggressive. Especially this can happen sometimes if they have a certain aggressive. Someone who's trying to aggressively take ownership of the company, they might keep that in their hands.
also have price stability of the stock?
They can manipulate the price of the stock, right? Because by buying those stocks, they will increase demand for the stock, right? Later on, if they want to decrease the price of the stock, they can release them again, right? Sometimes they can also take those stocks, because, basically buy them back because they want to issue them to their officers, let's say for compensation based on company's performance. Like we said, do you remember when we said the management sometimes they are rewarded with stocks to make sure that their goals are aligned with the company's goals. So to basically motivate the manager to improve the performance of the company and to improve the stock price of the company, what they do is they issue a bonus. Let's say that it's a bonus, the yearly bonus. Instead of giving them cash, they give them stocks. In this case, manager will have a better motivation to actually improve the performance so that the price of the stock will improve. Now, this is usually, later on, it is deducted from stockholders' equity. Let's see how this is done. So, treasury stock, like we said, why do companies do that? They acquire treasury stocks to, for example, again, sometimes it is to eliminate hostile shareholders. Like they buy them out, they get rid of them. If someone is making a lot of noise inside the company, they might just want to get rid of them. Sometimes they do that to have less shares outstanding. Remember that net income eventually will be divided by the outstanding shares, right? So if they want to increase earnings per share, it will be divided, the earnings will be divided over a lower number of shares outstanding. That would give a better number. It would become more appealing to outside investors. So if investors want to buy it, they will be looking at, okay, so this looks much nicer. It gives like a higher EPS. Okay? It enhances the stock's market value. Why? Because now you have less stock, so the demand will be usually higher. The supply is lower, at least they are lowering the supply. All these issues are reasons why company might want to buy those treasury stocks. Now, when the company purchases treasury stocks, what do they do? Remember, this is not an asset. This is contra stockholders' equity account. Yes.
If they purchase it, wouldn't they have to debit treasury stock and credit payer cash?
Yes. But then how? How much? How do they do that? So in this case, companies, they usually use the cost method. So to record the purchase of treasury stock, the company would use basically they use the cost method, okay? They debit treasury stock, they credit cash. In this case, it is the amount paid to reacquire those stocks based on the cost method. Okay? Because it is a contra equity account, it will decrease stockholders' equity. What you're saying is that those stocks are not part, basically they are not owned by shareholders, it's back to the company. So for example, on January 1st, 2015, Meet Inc.'s stockholders' equity section on the balance sheet shows 100,000 shares of $5 par value common stock outstanding. Outstanding, that means this is the amount of stocks of shares that are still owned by investors. Retained earnings is 200,000, so this is how it would look like. Remember, when you are preparing the stockholders' equity section of the balance sheet, you have two main components. You have paid-in capital, retained earnings. Paid-in capital, you would have whatever stocks you have. You have common stock, preferred stock, etc. You list them in this section. So in this case, you have common stock. How many do you have? 5,000. Basically, you have 400,000 shares outstanding, 100 shares issued. 400,000 that are authorized, but the company only issued 100,000. Those are the ones that are outstanding. how many treasury stocks does the company have? 0. If they are not issued, they are not out there. The company has the right to issue those stocks, but they are not out there. So the outstanding only, the outstanding ones will be part with, basically the issued ones will be part outstanding, part outstanding, and the other part will be treasury stock. The ones that are authorized, the company will disclose them to tell the investors that, okay, I have the right to issue, in this example, for example, I have the right to issue 300,000 shares. It does not mean that the company will issue them. The company has not issued them yet. You look only at the ones that are issued and outstanding. So in this case, those are issued and outstanding. It's 100,000 shares. This is the value that will be multiplied by par value. What was the par value? $5. Remember in this example, par value is $5. So common stock, the value of common stock, the amount that will show on the balance sheet is 500,000. They did not say anything about paid-in capital in excess, so we do not include it. The other part is retained earnings is 200,000. As a result, total stockholders' equity is 700,000. Now, on February 1st, 2015, the company acquires 4,000 shares of treasury stock at $8 per share. This is how much the company bought back. Out of those 100,000 shares that are outstanding, that are issued and outstanding, the company bought back 4,000. How many are issued? It's still 100,000. How many are outstanding now? 96,000. And the difference between the two are treasury stocks. We have 4,000 of treasury stocks. Remember, treasury stocks is recorded at cost. How much did it cost the company to acquire those treasury stocks? $8 per share multiplied by 4,000 shares. So we debit treasury stock 32,000 at cost. So this is cost. Okay? How much do you credit common stock? Nothing. This is because you're not retiring them. You're simply buying them. So you credit cash. Okay? That's the here you're not retiring them. You're simply buying them back and keeping them in your vault. Those are your stocks. They are still available. They are issued. However, they are in the company's vault. So the company will debit treasury stocks, credit, cash at cost. Good? Now, the presentation now becomes different. We have common stock, paid-in capital. It's still $5 par value multiplied by 400,000, right? Come on, right? Wrong. Okay, the 400,000 are authorized, they are not issued. See? That will keep you up. The problem is that I need to explain it before we go to the clicker questions. So, help me out here, wake up so that we could get to the clicker question. It's like, I don't know. Sometimes it gets me all frustrated. So we have 100,000 that are issued. Okay? 96,000 are outstanding. 96,000 shares are outstanding. So the common stock is 500,000, retained earnings is 200, less the 4,000 that are in the stock. So those two together would be 96,000 multiplied by the amount. Okay, now let's see both. So now we have the total is 668,000 compared to the previous one, which was 700,000. So the treasury stocks decrease stockholders' equity. Okay? Because this is what you did. What you did is actually you decreased your assets by 32,000 because you paid cash. So your total assets decreased by 32,000, and at the same time, your stockholders' equity decreased by 32,000. That's not a liability. That's not an asset. Okay? This is simply the company buying back part of their stocks. So they are, in a way, they are basically giving back part of their equity. So this is why their equity will decrease. Owner's equity will decrease. Okay? So this is when the company buys. This is when the company buys treasury stocks. Now we'll talk about when the company decides to dispose of treasury stocks. They can sell treasury stocks either at above cost or below cost. If you remember in the example, they bought it at $8. Right? They purchased it at $8. When they sell it back to investors, in this case they will increase both assets and equity. They will have more shares outstanding, right? So let's see how this happens. Sorry. So on July 1st, meat sells for $10 per share. Is it below cost or above cost? Above cost. The cost was, to them, was $8 per treasury stock. In this case, per share it was $8. Now they're selling it for $10. So meat sells for $10 per share. $1,000 shares of its treasury stock previously acquired at $8 per share. So what do? They receive cash, how much? $10 multiplied by 1,000. So this is the amount of cash that they will receive. They will credit treasury stock 8,000. It's at cost, right? This is how much it costs. What about the difference between the two? Paid in capital from treasury stock. Do you understand now how this works? So the one way to do it is to memorize these things. I don't recommend that. I recommend that you try to understand how these things happen. The company purchased those treasury stocks, so they recorded at cost by debiting treasury stock, crediting cash, right? Later on when they sell it, if they sell it above the cost, cash, this is the amount of cash that they will receive. So it's going to be based on how much they sold it. It's $10 per share, that's $10,000. The difference between, and treasury stock was recorded at 8,000. So we credit treasury stock 8,000. The difference between the two will be credit to paid in capital. Okay? This is the reason why we put it as paid in capital from treasury stock is that this is not a gain or a loss. The company is not selling an asset. That's not an asset, that's a stock. Equity. Okay? The company is selling that, or is issuing those, basically those stocks. Is selling those treasury stocks. They are not selling some kind of asset. It's not like a building or a truck. So they cannot have a gain or loss, which is usually the result of selling an asset. So on October 1st, Mead sells an additional 8,000 shares of treasury stock at $7 per share. So the first time they sold 1,000 shares, it was for $10. Now they are selling it below cost. They are selling treasury stocks for $7. Okay? How much cash will they receive? 800. It's very simple. It's 800 multiplied by 7. This is the amount of cash that the company will receive. So this is again based on sales price. What about treasury stock? It would be credited how much? 800 shares multiplied by 8. This is how much it costs. Right? This is 800 multiplied by 8, which was at cost. So treasury stock in both cases, whether it was sold at above or below cost, treasury stock will be credited. Treasury stock will be credited the same value, will be credited based on the cost. Cash will be based on how much they received from the sale. The third part will be the difference between the two. Will be, in this case, it is a debit to paid-in capital from treasury stock. It's decreasing paid-in capital from treasury stock. So basically what you said is that we took part of the paid-in capital, we decreased that amount from treasury stock. Any questions about this? So in this case, as you can see, the treasury stock originally was purchased for $32,000. First time the company sold, so we sold 8,000, the value of $8,000. So it was credited to treasury stock, and then the second time we credited, like here, 6,400. That's the new balance of treasury stock. Remember, this is a contra equity account, right? So the normal balance is a debit balance. The paid-in capital from treasury stock, the first time it was 2,000. This is when the company sold treasury stocks above cost, and then the company issued, they sold treasury stock below cost. So there was a credit in the first time there was a credit of 2,000, and the second time there was a debit of 800. Yes.
Why is it 2,000 above cost?
That was in the previous slide. The cost was 8,000. This is cost.
Oh, I didn't know we were carrying over. Okay.
And this is the thing. It carries over. It's a T account. So the first transaction, it was 2,000. You had a credit of 2,000. Okay? So this is a credit. Here, this is based on the sales price. So the first time, you credited that amount 2,000. In the second transaction, that's here. This is the one that we had here. This is the amount here. It carries over, right? Now, the new balance is how much? $1,200, right? Under paid-in capital from treasury stock. Let's say that the company, again, they sell the remaining 2,200 shares at $7 per share. Is it below cost or above cost? Sorry? Below cost, right? Remember, cash will be based on the sale. So cash will be debited. 2,200 multiplied by 7. Paid-in capital would be debited 1,200. 17,600 will be credited to treasury stock. So this is based on what? This is equal to 2,200 multiplied by 8. This is 2,200 multiplied by 7. That's the remaining balance in paid-in capital. Did you remember this one? In the balance. The balance was 1,200. You do not have a negative balance. You cannot have a negative balance in paid-in capital. So what happens is that when you are selling, at a certain point, when you are selling treasury stock, if you keep selling it below cost, the difference will have to be taken from retained earnings. This is why here we debit retained earnings. Those two together is the difference between the sales and the cost. Do you understand this point here? Okay. But you cannot have a negative balance in paid-in capital. Instead, what you do is, what do you do? When you need additional money to basically cover the difference between the cost and the sales price of treasury stock, you use retained earnings. So, the company, they sell 100 shares of $5 par value treasury stock at $13 per share. If the cost of acquiring the shares was $10 per share, the entry for the sale should include what? Again, you write the journal entry. The company is selling treasury stock. So what do you do?
Debit treasury stock.
First, you debit? No, the company is selling.
Oh.
The company is selling 100 shares. So the company will debit cash. How much? It is at $13. So it's $1,300, right? This is based on the sale. The company will credit treasury stock based on cost, which is, it is 100 shares, it was $10, so it is 1,000, right? The difference between the two will be paid-in capital from treasury stock. That will be what? 300. So this is why it will be a credit to treasury stock and paid-in capital. This is a similar problem. Again, those are problems that are very similar to the ones that you might have in the final exam. Okay. So that's the correct answer. You see, here the company paid $45,000 to buy 9,000 shares. So when the company, the cost was equal to 45,000 divided by 9,000 shares, it was $5 per share. Company, they paid 45,000 to buy 9,000 shares. So the cost was equal to 45,000 divided by 9,000 is equal to $5. That's the cost. This is the cost. Okay? The company, when they sell it, the company entry to record the sale. They sold it later at $6. So the company will receive cash equal to 9,000 multiplied by 6, right? And then you have treasury stock. That's the same. This is at cost. It will be 9,000 multiplied by 5, which is 45. The difference between the two will be paid-in capital from treasury stock. Because you have more cash, basically the sales price is higher than cost, you credit paid-in capital 1,000. It's 1 multiplied by 9,000. Go this way. 9. Okay, so it is 9,000. I'm going to write it here as cash minus cost. They look the same. So it was sale minus cost. Well, they look very similar, cash and cost. Don't ask me how. Any questions about that? Now we'll start talking about preferred stocks. Like we said, preferred stocks is a different type of stocks that the company can issue. Usually, those stocks are more expensive and they have no voting rights. However, they have preference when it comes to dividends. That's why they are preferred. Plus, in the case of the company going bankrupt or in the case of liquidating that company, they have preference against, and they have like a stronger claim against the assets of the company than common stock. Basically, preferred stocks will get all their money before common stocks touches even 1 penny. So all the money will go first until all the preferred stocks have been paid, common stocks do not get anything. So if the company declares dividends, okay? If the company declares dividends, common stocks do not get anything until preferred stocks have received all their money. Usually, because they are preferred as well, they are listed on the statement on the balance sheet and under the stockholders' equity section. They are listed before common stocks. Right? First, you have under paid-in capital, you would have preferred stocks, and then you have common stocks. So, Sign Corporation issues $10,000 shares of $10 par value, preferred stock for $12 cash per share. What's the journal entry? Now, the journal entry to account for the issuance of preferred stocks is basically the same thing as that of common stock. So in this case, how much did the company get in cash? 120,000. It's 10,000 shares multiplied by, this is multiplied by 100. It's 10,000 shares multiplied by 12. So this is basically according to sales. Preferred stock, it could have a par value, it could have no par value. In this problem, does it have a par value? It has $10 par value. So preferred stock will be 10,000 multiplied by $10 per share. So this is a par value. The difference between the two will be credited to paid-in capital in excess of par value for preferred stocks. Do you have any questions about this? So this is the same way, but instead of talking about common stock, we're talking about preferred stock. Now, we get to dividend preference. Most companies, or at least a lot of companies, they use something called cumulative dividend for preferred, for those preferred stocks. What we mean by cumulative dividend is that if there were any dividends from previous years that were not declared and paid last year, they will accumulate. So for example, let's say that I have a preferred stock. I should be getting every year, so the company would have a certain number. Let's say that it is 8% or $2. So it could be an amount or it could be a percentage. Let's say that it says $5 dividend per share every year. Even if the company this year does not declare and pay out dividends, this becomes what we call dividends in arrear. Those are dividends that the company will have to pay. It's not an obligation yet, so it's not a liability because the company has not declared those yet. What we mean simply is that if there are 2 years in arrear, so there are 2 years from in the past that the company did not pay any dividend, did not declare and pay dividends. This year, if they declare and pay dividend, the company will have to pay the preferred stock. They pay them dividends for the past 2 years. And this year, before they actually give anything to common stock. Common stocks, from the previous years, they don't get anything. It's whatever is declared and paid this year. So this is why people might be willing to pay more for preferred stocks. They don't care about control, they don't care about voting, what they care about is to get dividends. So let's see how this is done. Scientific Leasing has 5,000 shares of 7%, $100 par value, cumulative preferred stock outstanding. Each $100 share pays a $7 dividend. Okay? That's 7%. The annual dividend is $35,000. If dividends are 2 years in arrears, what's the amount that will be paid to preferred dividends? Remember, 2 years in arrears, that means there were 2 years where those preferred stocks did not receive this amount. They did not receive the annual dividend of $35,000. So because they have 2 years in arrears, it will be what? $70,000 for the past. For this year, it's $35,000 as well. So how much do they actually get? It will be $105,000. So if the company this year declares $120,000 dividends and they pay $120,000 dividends, preferred stocks will get $105 common stock will have 15,000. If the company pays 100, common stocks get 0. So that's how it works. Again, in the case of liquidation, they come right after the creditors. So creditors are paid first for their liabilities, and then everything will be paid. But basically, preferred stocks, if it's a cumulative right, they will get assets after, basically for the par value as well as depending on the preferred stock, if it's cumulative, they might get also all dividends in arrears. As far as But generally speaking, what we mean here is that they have access to their money before common stock. This is what I want you to remember from the preferred stock. Okay? That's bad.
No one knows.
That's really bad.
Put 0.
12,000. So you see, it is 6%. So it's 6% cumulative preferred stock, okay? They were 100. Well, this 1,000 shares multiplied by $6, right? This is 6% of 100. This is per year. So it's per year, it's 6,000 per year. No dividends have been paid on stock for 2010 and 2011. So dividends in arrears at December 31st, 2011, those are the ones that were not paid, right? This is how much? You multiply. So every year, it's not paid. So when they have to declare their financial statements, etc., the dividends in arrears are 12,000. We get to the distribution of dividends. Okay? Dividends could be, this is whatever part of net income that the company decides to share with their shareholders. They give back to their shareholders, right? The most common form of dividends is, of course, cash dividend. Another frequent type is also called a stock dividend. This is when the company does not want to pay cash. What they do is they issue additional stocks and they distribute them to their shareholders. You also have property dividends and scrip, which is like promissory notes. Those are less frequent. So this is why we are going to focus here on cash dividends and stock dividends. Okay? Generally speaking, dividend is distributed on a pro rata basis, which is to mean if you have 10% share of the company, you get 10% share of the dividend that is declared and paid. Okay? If you own 20% of the company, when they pay out dividend, it will be 20% of the dividends. Any questions? Okay. Usually, before the company declares and pays dividends, for the board of directors authorizes the payment of dividends, they need to make sure that they have enough in the retained earnings, because remember, dividends cannot be paid from the capital. Dividends can only go from retained earnings. Remember that this is coming from net income, right? Net income is close to retained earnings. So this is why dividends cannot be paid from paid-in cash. If the company is paying cash dividends, the board of directors need to know that the company has enough cash to continue their business. So although the company might have retained earnings of, let's say, $1 billion, but if they don't have cash enough to run their business, they're not going to declare dividends. Okay? Dividend is not an obligation until it is declared. And basically, it's the board of directors who declare dividends. Basically, they give the authorization, the management, to pay out that dividend. There are three important dates when it comes to payments when it comes to dividends. Okay? The first thing is when the board of directors declare dividends. They decide that, okay, we made enough profits and we would like to share them with our shareholders, so we will declare such and such dividends. So this is the first day. This is when it automatically becomes an obligation. Company will declare the obligation because they have to pay that dividend, but they have not paid it yet. The second date is a record date. This is when they actually update the records they have. Basically, the owners of the stocks, as of a specific date, who are the owners of those shares, because those are the ones who will receive the checks. They will receive the payments of dividends. In this case, no journal entries are done because the company is simply updating their records. No money was transferred, no obligations, no assets, no liabilities, nothing was affected. The third date is when the company actually makes a payment. Let's see how the journal entries are done. On December 1st, the directors of Media General declared a 50 cents per share cash dividend on 100,000 shares of $10 par value common stock. The dividend is payable on January 20th to shareholders of record on December 22nd. Usually, between every date and the other, there are like 2 to 4 weeks. This is why you have here 2 to 4 weeks. It's just give them time to actually update the records, prepare the payments, etc. So on the declaration date, now the company has an obligation. They will have to record the cash dividends. Is the company going to pay it now? No. So it is what? Okay, payable. It is dividends payable. It's a liability. The company has not made the payment. So the company will debit cash dividends, and usually companies they put what kind of dividend it is to make sure later on it's clear. So they have cash dividends, stock dividends, etc. So cash dividends is debited, the amount that was declared by the board of directors, and dividends payable is credited that amount. The company did not make the payments yet. On December 22nd, this is the date of record, there is no entry required because the company is simply updating their database of users, their users' database. No transaction happened on that day. Okay? The last date that is important or relevant to the declaration and payment of dividends is the payment day. This is when the company will actually send out the checks, the payments. So cash will be credited and dividends payable will be what? Debited. So dividends payable will be debited, cash will be credited. Any questions? A question? Now this is, here we will look at how it is distributed between preferred stocks and common stock. Again, the cumulative preferred stock will have precedence over common stock. On December 31st, 2015, IBR Inc. has 1,000 shares of 8%, $100 par value cumulative preferred stock. It also has 50,000 shares of $10 par value common stock outstanding. Okay? As you can see, the value of each stock is different. The value of common stock is different from that of preferred stock. At December 31st, the board of directors basically they declared a $6,000 cash dividend. First, you need to calculate how much is going to go to the preferred stock. You pay preferred stock. If anything is left, then you can give it to common stock. In this example here, we have preferred dividends. We'll have every year 1,000 shares multiplied by $100, and it is 8%. So every year they are entitled to $8,000. So for the first year, how much does the preferred stock get? All the 6,000, and they still have 2,000 in arrears. The journal entry will be cash dividends and dividends payable. That's the amount, 6,000 to 6,000. Okay? This is how you record the journal entry for cash dividends. You debit cash dividends, you credit dividends payable. You haven't paid it yet. At December 31st, the company declares this is the next year, so that was in 2015. Next year, following year, the company declares $50,000 cash dividends. Again, how much does preferred stock get at this point? 8,000 plus the 2,000 from the previous year. So it will be 10,000, 50,000. This is the dividend declared. Dividends in arrear are 2,000, and to preferred is 8,000. So that's 10,000 for the preferred. This is the preferred stock. The difference between that amount and 50,000 is 40,000. This is the amount that will be distributed to common stock. For the first one, in the first year, 2015, they did not get anything. 2016, they got 40,000. Just 1 second. This is the last one. December 31st, this is 2016. They declare 50,000. We need to prepare the journal entry for the declaration of the dividend. The company will have cash dividends 50,000, and then you have dividends payable 50,000. When it is later on paid, we debit the liability and we credit cash. As you can see, as far as cash dividend journal entry is concerned, it is always a debit to the cash dividend, credit to dividends payable. Have a good weekend.